In this lesson, we will explore introductory material that serves as a foundation for our understanding of financial statements. Note that the primary function of financial accounting is to provide useful financial information to users external to the business enterprise. The primary means of conveying information to investors, creditors, and other external users is through financial statements and related notes. Users of financial statements, such as investors and creditors, make critical resource allocation decisions that affect firms and national economies. As discussed earlier, financial statements convey financial information to external users. The four main financial statements are the balance sheet or statement of financial position, the income statement or statement of operations, the statement of stockholders' equity, and the statement of cash flows. Now let's look at the balance sheet. The balance sheet reports the balances of assets, liabilities, and shareholders' equity at a specified date, which is the end of the specified period. And in this case, for XYZ Corporation, the balances of assets, liabilities, and shareholders' equity accounts are reported as at December 31, 2014, which means that the balances could change the day after. Now, the balance sheet mirrors the accounting equation, which is assets equal liabilities and shareholders' equity. Now, assets are the users of funds, and liabilities and shareholders' equity represent the sources of funds, which means that all the assets, which total 368,678, were financed using either liabilities or shareholders' equity. Now, the shareholders' equity accounts represent ownership interests of shareholders. Equity consists of contributed capital, which is cash raised from the issuance of shares, and earned capital. And we will consider retained earnings under earned capital. Now we will turn our attention to the income statement. The income statement summarizes the profit and loss generating activities that occurred during a particular reporting period. So for XYZ Corporation, for the month of March 2016, we have sales revenues and expenses, resulting in net income of 98,489. Thus, we can say that the income statement reports sales revenues, expenses, gains and losses during a specified period. Now, the statement of shareholders' equity discloses transactions that cause changes in shareholders' equity account balances. Now, shareholders' equity is a residual amount. That is, what's left over after creditor claims have been subtracted from assets. Now, this is consistent with the accounting equation, which is assets equals liabilities plus equity, which means that assets minus liabilities equals shareholders' equity. Therefore, shareholders' equity can be considered as net assets, assets minus liabilities. Now, looking at the statement of shareholders' equity, note that retained earnings is updated for each period as follows: beginning retained earnings plus net income minus dividends, that is any dividends, equal ending retained earnings. Now, for XYZ Corporation, let's take note of two things. 2015 is its first year of operations. That is focusing on the statement of shareholders' equity. 2015 is assumed to be the first year of operations. So the balances at the beginning are zero. Second point, in the updating of retained earnings, there are no dividends. Not every company declares and pays dividends. So for XYZ Corporation, no dividends. So we only have net income, which yields the ending balance of 98,489. Let's now turn our attention to the statement of cash flows. Note that cash flows to investors and creditors depend on the corporation generating cash flows to itself. Decision makers rely heavily on the information reported in periodic financial statements to project a company's cash generating ability. Some important questions are not easily answered from the information the balance sheet and income statement provide. Therefore, the statement of cash flows fills an information gap left by the balance sheet and the income statement. The statement of cash flows reports the company's cash inflows and outflows during the period and categorizes them according to operating, investing, and financing activities. Let's begin with the operating cash flows. Operating activities include the cash effects of transactions that create revenues and expenses and enter into the determination of net income. So we see that many of the items under operating activities are related to the day-to-day business operations of the company. Cash provided by operations is generally considered to be the best measure of whether a company can generate sufficient cash to continue as a going concern and to expand. Examples of cash inflows, that is, positive cash flows under operating activities, are cash from customers for the sale of goods or services. Under cash outflows, we have examples like cash paid out for rent, cash paid out for insurance, and cash paid to suppliers for inventory purchases. We can also have cash paid to employees for services, cash paid to the government for taxes, and cash paid to cover interest. Now, let's look at the investing activities section. Investing activities involve cash flows resulting from changes in investments and long-term asset items. Now, what this means is, under investing activities, examples of cash inflows would include from the sale of property, plant, and equipment like buildings and land. We could also have cash inflows from the sale of investments in debt or equity securities of other companies. We can also have cash inflows from collection of the principal on loans to other companies. Now note that for XYZ Corporation, the only cash flow reported under investing activities is a cash outflow. Negative is a cash outflow, and this is for the purchase of equipment. So the company paid cash or some cash for the purchase of equipment, and it is an outflow. Other examples of cash outflows are the purchase of property, like cash paid out to purchase building or land. We can also have cash to purchase investments in debt or equity securities of other companies. Cash paid out to make loans to other companies.